Welcome, ACCA financial reporting students. Grab a seat. Today, we're diving into a standard that honestly trips up a lot of people in the exam room. IAS 36, Impairment of Assets. Now look, my goal as your tutor today isn't to just throw complex formulas at you right out of the gate. We're not doing that. Instead, we're going to master the pure, fundamental business intuition behind this standard. Because I promise you, once you understand the why behind the rules, the calculations, they're just going to naturally fall into place. Let's get into it.
To really get why the standard even exists, picture this scenario. You buy a gorgeous little apartment in Cape Town for 2 million rand. You're going to run it as an Airbnb. Perfect, right? Your books proudly declare, asset 2 million. But then, a sewage treatment plant opens up right next door. Yeah. The smell arrives, tourists start canceling left and right, and suddenly its future rental income is barely worth 1.1 million. So here's the big question. Can you honestly keep telling the bank you own a 2 million rand asset? I mean, should your financial statements just pretend nothing has changed? If you keep showing that old value, aren't you completely misleading your investors? You absolutely are. And that, right there, is exactly the problem IAS 36 was built to solve.
So here is how we're going to break this down today. First, we'll talk about the flattering lie. Then, scope and exclusions. Third, when do we actually test? 4, the big decision. Sell it or keep it. 5, we'll explain cash-generating units. And finally, Section 6, reversals and those tricky exam traps.
All right, let's jump straight into Section 1, the flattering lie, and why IAS 36 exists in the first place.
You know, pretty much every accounting standard exists because at some point, somebody was tempted to bend the truth. With IAS 36, it's all about stopping companies from keeping an asset on their balance sheet at a value it simply doesn't deserve anymore. So if you remember nothing else from this entire explainer, remember this one golden quote. An asset must never sit in the books at more than its recoverable amount. That single sentence is literally the beating heart of IAS 36. It's there to aggressively enforce the prudence concept, making absolutely sure we give a faithful representation to our investors.
Let's break down the jargon for a second. When we talk about impairment, we're really just comparing two numbers. On one side, you've got the carrying amount. That is the price tag your books currently show. You know, the historical cost minus all that accumulated depreciation. It's basically what you claim the asset is worth. But on the other side, we have the recoverable amount. And this is reality. It is what the asset can actually, genuinely still do for you today. If your carrying amount is higher than your recoverable amount, well, your books are telling a flattering lie. They're overstating reality, and that means you have to record an impairment loss to bring that number crashing back down to earth.
Moving right along to Section 2, scope and exclusions. Basically, who exactly does IAS 36 apply to?
Yep, IAS 36 applies to most of your standard non-current assets. We're talking property, plant, equipment, intangibles, but it very politely steps aside for a few specific items. And understanding why it steps aside is totally crucial for your FR exam. See, the whole IFRS framework is highly organized. IAS 36 doesn't want to step on the toes of other standards that already have their own strict rules for current valuation. Take inventory, for example. Why is it excluded? Because IAS 2 already ensures inventory is strictly held at the lower of cost and net realizable value. There's already a built-in reality check, so IAS 36 is needed. What about deferred tax assets? Excluded. They are handled by the very specific tax rules of IAS 12. And financial assets? Those are governed by IFRS 9, and they're typically measured at fair value anyway. So the takeaway here is that IAS 36 only swoops in for assets that don't already have a dedicated standard constantly checking their reality.
Okay, Section 3, when do we test? Let's look at the actual triggers for impairment.
A super common question I get from students is, wait, do we have to test every single asset every single year? And the answer is a massive no. That would be total madness for a company with thousands of assets, right? Instead, IAS 36 creates a sort of VIP list, and these VIPs must be tested annually, regardless of whether things look fine or not. Who's on the list? Goodwill, intangibles with an indefinite useful life, and intangibles not yet available for use. I always tell my students to remember them as GII. Think of them as the ghosts of the balance sheet. They don't have a physical body you can go kick to see if they're broken, right? And there's no depreciation quietly shrinking them down every year. So, the standard demands they prove their value every single year. But for everyone else, your ordinary physical assets, we only run the impairment test when there is an actual indication that something might be wrong.
So, what exactly does a warning sign look like? Well, the exam loves asking you to sort these indications into two buckets, external and internal. External indications, as you'd guess, come from the outside world. Maybe the asset's market value suddenly plummets, or a new adverse law is passed, like say the government bans petrol delivery bikes and you happen to own a whole fleet of them. Or, and this is a really great one to remember, market interest rates increase. Why does that matter? Because higher interest rates mean a bigger discount rate, which mathematically shrinks the present value of your future cash flows. Boom, external indication. Then you have internal indications, which come from inside the house. Physical damage, assets sitting idle, or just terrible performance reports showing worse than budgeted numbers. But, and listen closely because this is a crucial exam point, does every fall in market value mean an asset is automatically impaired? No, absolutely not. An indication just means you have to run the test. It's the test that decides the impairment, not just the warning sign.
Which brings us perfectly to Section 4, sell it or keep it. Let's calculate that recoverable amount. Let's keep this really simple. In business, an asset can genuinely only do two things for you. Door number one, you sell it to the market. In fancy accounting terms, this is fair value less costs of disposal, or FVLCD. Door number two, you keep it and use it. And why do we estimate future cash flows here? Because if you keep it, the asset's worth is entirely tied to the money it will generate for your business over time. We call this value in use, which is just the present value of those future cash flows.
And here, my friends, is the golden rule of IAS 36. The recoverable amount is always the higher of those two options. Always. Why? Because we assume you are a rational business owner. Think about it. If your delivery van would sell for $80,000, but keeping it and using it would earn you $95,000, what are you going to do? You're obviously going to keep it. An asset is worth the best possible thing you can do with it. So you find that higher number, and only then do you compare it to the carrying amount in your books.
Let's look at a quick, friendly example to make this concrete. Imagine you own a commercial coffee machine. Your books say its carrying amount is 50,000 Rand. Now, if you choose door 1 and sell it, you'd get 38,000 after all the disposal costs. But if you choose door 2 and keep using it to sell coffee, it will generate 45,000 in today's money. Step 1. Take the higher of the two doors. 45,000 is obviously higher than 38,000. So boom, your recoverable amount is $45,000. Step 2. Compare your book value of 50,000 to your real recoverable value of 45,000. The books are claiming too much, so step 3, you book an impairment loss for the difference, which is 5,000. Simple as that, right?
But watch out, because ACCA examiners absolutely love testing the fine print when calculating those two doors. For selling it, the FVLCD, you must deduct direct disposal costs, like legal fees or dismantling costs. But you must absolutely 100% ignore sunk costs. If you've already paid a professional valuer to estimate the price, well, that money is gone whether you sell the asset or not, so exclude it. Now, for keeping it, the value in use, your cash flow forecast has to reflect the asset in its current condition. You cannot include cash flows from some fancy future upgrade you haven't even committed to making yet. Oh, and notice how both doors completely ignore finance costs and tax. Examiners love to sneak those in to distract you. Don't fall for it.
Moving on to Section 5, Cash Generating Units Explained, or as I like to call it, testing the team, not the player.
Students ask me all the time, what on earth is a cash-generating unit, and why can't some assets just generate cash on their own? Well, think about a bakery oven. What are the future cash flows of just the oven sitting by itself? Literally nothing. It only makes money when it works together with the till, the display counter, and the building to actually sell croissants to customers. So when the individual impairment test breaks down because the asset can't make money alone, we test the team. This team is called a cash-generating unit, or CGU. The formal definition is the smallest identifiable group of assets that generates cash inflows largely independent of other assets. Now that word smallest is doing a lot of heavy lifting here. Imagine a big airport. It has a super profitable international terminal and a completely loss-making domestic terminal. If they are legally linked by a government license, meaning you literally cannot close the bad one without losing the license for the good one, then they aren't independent. They have to be tested together as one giant CGU. The rule of thumb I use is, can I shut this specific piece down and the rest of the business carries on just fine? Using the smallest possible group ensures that loss-making assets can't just hide underneath the profitable ones.
Now, when a whole CGU is impaired, we have to allocate that loss among the different team members. And IAS 36 makes us follow a very strict waterfall method. Step 1, goodwill takes the hit first. Why? Because goodwill, which is basically the premium you paid for a business's reputation, its customer loyalty, its overall vibe, is the softest, squishiest number on the balance sheet.
If the business unit is failing, the vibe is absolutely the first thing that's lost its value. So you wipe goodwill all the way down to zero if you have to. Step 2. Any remaining loss is then spread out pro rata across the other physical assets in the unit, based on their carrying amounts. Just remember, innocent bystanders like inventory and receivables, they don't take any of the hit. Why? Because as we talked about earlier, other standards already make sure they are valued correctly.
All right, home stretch. Section 6, reversals and exam traps. Everybody loves a good comeback story, right? Let's say that awful sewage plant next to your Airbnb finally closes down, the smell clears up, and the tourists come flooding back. Can you reverse that old impairment loss? Actually, yes, but with some very strict guardrails. First off, there has to be a genuine change in estimates. The market has to actually recover. You can't reverse it just because some time has passed. Second, and this is a big one, the reversal is capped by what we call the ceiling. You can only bring the asset's value back up to what its depreciated historical cost would have been today if the original impairment had never even happened. This rule is there to stop companies from magically manufacturing fake profit out of thin air. And third, this is an absolute non-negotiable golden rule. Goodwill impairments are never allowed to be reversed. Never. Students always ask me why. It's because any subsequent increase in goodwill is treated as internally generated goodwill, which accounting standards strictly forbid you from recognizing. So with goodwill, once it's burned, it stays burned.
We also need to talk about booking the impairment loss for assets that were previously revalued upwards. I want you to burn this analogy into your brain. The mattress. If your building was previously revalued upwards, that gain is sitting in a revaluation surplus through other comprehensive income, or OCI. I want you to think of that surplus as a thick, fluffy mattress sitting right underneath the asset. When an impairment happens, the asset falls and the mattress absorbs the fall first. The impairment loss eats into that OCI surplus cushion. Only if the fall is bigger than the mattress does the overflow actually hit the hard floor of profit or loss. Do not just dump the whole impairment loss into profit or loss if a revaluation surplus mattress exists.
Okay, let's rapid fire through the classic ACCA FR exam traps so you don't hand the examiner free marks. Trap number 1. Students often compare the carrying amount to the lower of the two doors, or they just lazily compare it to fair value. No, always find the higher of sell it or use it first. Trap 2. Deducting sunk costs like already paid valuer's fees in your FELCD calculation. Ignore them. Trap 3. This is probably the most forgotten step in the entire exam. After an impairment, you absolutely must restart your depreciation calculation based on the new lower carrying amount over the remaining useful life. And trap 4, wrongly allocating a CGU's impairment loss to inventory or receivables. Like we said, leave those bystanders alone.
And just like that, that wraps up our journey through IAS 36. We started with a balance sheet trying to tell a flattering lie about a smelly Airbnb, and we've walked through the precise, logical machinery designed to stop it. Test the ghosts annually, test the physical assets only when the warning signs flash, rationally choose the higher of selling or using, and always let the mattress absorb the fall first. So now that you actually understand the intuition and the real-world purpose behind these rules, ask yourself, how will enforcing this truth change the story you tell in your practice exams tomorrow? You've absolutely got this. Keep practicing, and I will see you in the next explainer.